Hello, everybody. My name is Scott Crace. I am the founder and president of a fee-only wealth management fiduciary firm that we call Crosspoint Wealth. We're going to be focusing on one of our articles for our blog, which is right here, Common Financial Sense. But one thing I wanted to point out to you is we actually have added a great deal more of educational videos that I think you'll really enjoy watching. Also, in terms of speaking engagements, I am a public speaker. I love going out there and connecting with my audience. There's a couple different areas that I really focus in on. One is I feel that financial literacy for all. So in terms of a company, if you have employees and maybe they're not getting a retirement readiness plan is part of their overall 401k system, if they're not being educated with public speaking, that's something that we definitely can do as well. So talk to us about that. Or just in terms of if you are hosting a conference and you need a speaker as well, that's something that we do. Okay, let's dig into this. So I love this article. It's called 5 Crucial Money Facts That Could Potentially Increase Your Return. And I do like the comic book theme. So it's going to be the mutual funds versus the exchange traded funds, right? So as we continue to learn a little bit more about this, the article's 5 crucial money facts for zeroing in on the cost savings and ideas that could potentially increase your returns, right? Oh, and by the way, ditching the time-wasting and expensive money-wasting products before your next statement arrives. So let's get right to it. Are you using mutual funds? It's been my experience that investors don't want to give themselves a raise and lower their costs. Well, why is that? Well, that's what we're going to dig into today in terms of here are 5 crucial money facts that can help explain that. So one of the things in terms of is if you look at the type of firm you're using at, this is a big red flag. Are they using proprietary products? So if the name on the building is predominantly the same type of mutual funds, are you using 99% of the company's mutual funds, who really benefits that? You or them? That's something to really think about. So let's dig into this. The money fact number 1, ETFs have liquidity and mutual funds don't. ETFs or exchange traded funds trade intraday. They are exchange traded just like stocks. You can buy or sell throughout the day when the market is open. On the other hand, mutual funds do not trade during the day, and the buy or sell of those shares only happens once per day at the end of the trading day after the markets are closed. So that definitely is a huge one in terms of liquidity. Transparency is another one. So money fact number 2, transparency. ETFs disclose their portfolio holdings in the companies that they represent in the ETF on public, free websites every single day of the year. Investors know what they are invested in and where the money is actually allocated. It's extremely important. Mutual funds only disclose their holdings quarterly, and then only with a 30-day lag. In between reporting periods, investors have no idea if the mutual fund is actually even invested. That's something that could be harmful. Money facts number 3 is tax efficiency. Ooh, good one here. Here's a quick tip. If a mutual fund or ETF holds securities that have gone up in value and then sells them for any reason, they can create a capital gain. And by law, they must pay them out to shareholders at the end of the year, to you. ETFs tend to be more tax efficient than mutual funds because of how they interact. The mechanics of the ETF shares are created and redeemed is really the true answer. And because of that mechanism, they don't have the same capital gains that are being kicked out like the mutual funds. So really, let me know in the comments section if you're interested in learning more about the mechanics of those ETF shares, and we could do another post for you. So when mutual fund investors want their money back, the mutual funds sell those securities to raise cash to meet that redemption. This causes a reaction to the entire portfolio and affects all of the shareholders, hence more capital gains. All right, money fact number 4, ETFs typically have lower expenses. ETFs generally will have lower expenses than mutual funds. Exchange traded funds have little or no trading costs. and tend to require less marketing and often fewer distribution costs than mutual funds. That's a part of the lower fee as well. Index mutual funds are a close second, but generally ETFs are going to be the least expensive vehicle, the cheaper unit, if you will. And the trade wars are going on and continue to be lower out there as well, but that can only be good for the individual investor. And really, money fact number 5, this is a good one, it's fees. So most investors know how to check the mutual fund expense ratio, I'm hoping, but that's not the real bottom line. Fees can come in many very forms and shapes and sizes. So let's dig into 5 ones that I really want you to pay attention to. So administrative fees, and this is the cost of running the fund. Number 2 is just the management fees, which are the cost for managing the fund's assets, little operational aspects. The 12b-1 fees are those marketing fees that they have to pay, whether it's salespeople that are out there or other aspects that belongs with marketing itself. Number 4, you're going to have the loads. Check. Is there a front-end load for that mutual fund? Is there a back-end load? And then even if they don't have those, check again back to just the expense ratio on what you're trying to do. Is there a cost to buy that mutual fund or sell it? And then is there a holding period? If you bought a mutual fund today but got out of it a week later, is there going to be a penalty? Is there typically a 90-day holding period that you have to hold the fund, or else you're going to be charged an additional fee, an exit fee, if you will. So be aware of that. And then just the transaction expenses within the fund, that I mentioned right then and there, that last one in that example. So unfortunately, many investors don't realize that they are paying too much in fees with those mutual funds. And people that are owning mutual funds and 401ks, look at them even less. So especially if you're working with a broker who does not have a fiduciary duty to keep your best interests first. That's what it means. Fiduciary means clients first. Myself, I have to do what's in your best interest above anything else that is out there. So decide who you're working with. Maybe it's time to get a professional second opinion. If you'd like a professional money manager to help you manage your investments going forward, if you have a rollover old 401k, and if you're a CFO out there or HR department and you would really like some extra education for your employees, do you offer a retirement readiness plan or financial plan to your employees to make sure that they're actually achieving those savings goals? We do it through education, information, technology, and tools to empower those employees to reach their goals. Okay, until next time, Scott Crace, founder and president of a fee-only fiduciary wealth management firm, CrossPoint Wealth. Take care.